Hello, everyone, and welcome to the Halftime Update 2019. My name is Adam Koch. I'm President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio. Believe it or not, we're already halfway through the year, and it's time to go back, look at the last 18 months or so, kind of see where we've been, where we are, and where the market might be taking us here going forward. So first and foremost, let's take a look at the market this last 18 months. Right off the bat, what I see is going back to January of 2018, I see a market that's really not gone much of anywhere. So been pretty frustrating, to be honest. And I think any investor probably feels that way with the market obviously going down here 20%. Earlier 2018, it went down 10%, then it went down 8%. Again, we saw a 20% decline from September 21st through the end of the year. And just again, a very frustrating 18-month period. Momentum has managed to trade back above the bullish and positive 70 level here, whereas in 2018, if you look back to September, November, December, and I'll kind of highlight that here, it really struggled to get above 70, and more importantly, down here we spent a few trips going below the 30 level, which is not healthy at all. However, again, unlike what we saw in 2018, in 2019 so far, we've got a cross above it here. You could argue there was a kind of a tiny little peak above 70 and momentum here, but more importantly, again, we're staying above that bearish negative 30 level. So where we want to be is we want this market printing higher highs, and we want it to be the momentum indicators to be showing us crosses above 70 and staying above 30, and ideally even 40, really, to be honest. But so far, that's kind of what we're seeing. So moving on to the next chart, we have the 10-month moving average. Now, every candlestick, so every white and black candlestick on this chart here, little ticks, represent 1 month. Now, the 10-month moving average, which is the smoother line here, this represents the average movement of the market over the last 10 months, and it just kind of keeps going and smooths out those monthly candlesticks with a smoother trend. Now, if the market closes at the end of the month, if the market closes below that 10-month moving average, this is generally a big red flag for the market risk-wise. Now, while this is not my primary indicator for the market, it's one I pay pretty close attention to. So, and the way I think you should need to think of it is almost like a tornado siren. I know I've used this analogy before, but while infrequent, you can see over the last 25 years, because that's what we're looking at here, is a 25-year time period, and all these rose-shaded areas are times when the market at the end of the month closed below that 10-month moving average. You can see it's been, while infrequent, again, only 15 signals, it can avoid financial tornadoes like the ones we saw right here in 2000, 2001, 2002, as well as the 2007, 2008, 2009 crash that can be really catastrophic. So when the sirens go off, I think it's best to go to the basement. And again, there's been now 15 of these signals, and 2 of them got you to the basement, I should say, before half of your financial house was wiped out. And the 15th siren just literally went off at the end of May. But June, this big, huge white candlestick here, so right after the black one, this white candlestick that went up kind of negated and took the market very convincingly back above that 10-month moving average. So it brought back the sunny skies, we'll call it. The risk of tornadoes is very low at this point, and at least for now, risk levels appear pretty low, and the prospects for higher prices, I think, look pretty good here. Next chart we'll look at, this is another momentum indicator down here in the lower pane. Whenever the black line crosses above the signal line, that's a positive or a buy signal. That's the blue arrows up here. When it crosses below it, you get a red sell signal. Back above it, blue buy signal. Back below it, red sell signal, and so on. So basically, we're looking for positive and negative crossovers here down in the bottom. Now, it's very slow moving, and that's why I like it. In the last 25 years, it's been right twice. So here it's been right, here it's been right, and it's been wrong twice. So the sell signal here in 1998, as well as the one that took place in 2015, both of those were wrong. The question now is this most recent signal right here that took place in November of last year, November 2018, the question is this most recent negative signal going to turn out to be wrong as well? And looking at the actual indicator down here in the bottom, you can see here that black line is trying pretty hard to cross back above the single line. So, if I had to speculate, I'd have to say that with all the other evidence in front of me today, that, some of which I'll share with you here today, as well as stuff that I just won't have time for, I think we'll probably see a buy signal at some point in the near future here, and probably again higher prices. Moving on to the next chart here. This is another look at 3 different time frames on one page. The top one is every candlestick is 1 week. So we talked about how earlier that every candlestick was 1 month. This one's a weekly chart. So the beginning of the week is the one point, and the end of the week is the other point. If it's white, that means the market opened at the bottom and closed at the top. So it was a good week. And if it's hot or solid or heavy, it means the market opened at the top and closed at the end of the week. It closed at the bottom, so it was a bad week. And then the blue and red solid lines that you're seeing here are the 13 and 34 week moving averages respectively. So in the middle pane here, we're looking at a daily chart. So every tick is a day, not a week. So it's a little bit faster moving. And then on top of that, I've got a 20 over 50 day. So the blue line is the 20-day moving average. The red is the 50-day moving average plotted, and you can see the crossovers there. And then the bottom one is the fastest. This is the same daily chart. So the bottom and the middle are both daily charts where every candlestick is 1 day. But the difference here is this is an 8-day. So the blue line is the 8-day moving average, and the red line is the 20-day. So this is ultra fast. You're going to see how choppy this was in March, May of last year. And then even as the market went down, we got a sell signal, buy signal, sell signal, buy signal, sell signal, and so on. So I think the key here is not to follow necessarily one particular indicator all on its own. I think it's best to take a weight of the evidence. And to get to the point, when I look at all 3 of these, we've got the short term being up, mid-term, intermediate term up, long term up. So in all 3 of these cases, again, you can see how we've got choppiness here. So we could see sell signals in the short term, but the bottom line here, all time frames, the market trends are currently up, which again adds more evidence to the idea that we could see higher prices in the months ahead, and not as much evidence that lower prices are ahead. Go to a kind of a chart that all of our clients seem to really like. This is kind of my green light, yellow light, red light chart. When we're in the green, basically it's, all signs are go, full speed ahead. The yellow is kind of a cautionary area. When we're in the yellow area, I think that's where, that doesn't mean we should sell. That doesn't mean freak out. I just think that, we need to look at other indicators and other pieces of evidence that might suggest that maybe there's higher risk on the horizon. And then red, of course, would be, probably time to jump ship and cut your losses. So as you can see here, we've spent a lot of time in this yellow area over the course of the last 18 months. And that's just kind of representative of how choppy this market's been. But at the end of the day, we have a high right here. We have a higher high right there. We've got another higher high here at the beginning of May. And then we've got another high just this month. So, I think, again, the path of least resistance is probably up from here, even though anything can happen. But that's why we have risk levels, and that's why we're always paying attention to where the market's at in terms of where it's been, and several other indicators, including but not limited to the ones we've shared already today. Because what we're trying to avoid here is not the little drops in the market. Nobody can do that. I shouldn't say nobody. I think people can do it. I think you're generally lucky if you can catch short-term swings on a frequent basis. But I think most investors or traders, I should say, are pretty happy if they're making, if they're winning 60 to 70% of the time. I'd say that's a pretty good win ratio. So at the end of the day, I'm not trying to find ways to, get every 2% increase and avoid every 3% decrease in market value. What I'm trying to avoid are these big, huge losses, like we've seen in 2000, 2001, 2002, 2007, 8, 9. And what this chart shows us here, if you lose 11%, all it takes is a 10%. I'm sorry, if you lose 10%, all it takes is an 11% gain to get back to even and break even. If you lose 20%, even 20% is not horrible. It only takes a 25% gain to get back to even. However, if you lose 30%, it takes 43% to get back to even. If you lose 40%, it takes 67 to get back to even. If you lose half your money, you have to make 100% gain just to get back to where you started, and then things just get messy from there. If you lose 60% of your money, like a lot of people did, in 2007, 8, and 9, in a very short period of time, by the way, only 18 months. You got to earn 150% just to get back to even. So you could spend, like the market, the S&P 500, the break-even point was somewhere in the ballpark of 6 years, 8 months, just to get back to where you started. And that's if you weren't spending any money. Obviously, if you were taking systematic withdrawals from your portfolio, it took even longer. And in some cases, people have probably struggled to get back to even at all. So this is what we're trying to avoid. Again, these tornadoes, when the warning signs go off, we want to make sure we're going to the basement. So let me close today on just something new I've never done before, at least in this forum, is to share my favorite stock right now. So just full disclosure, this is one of my favorite stocks, but we do own it. And again, to be clear, we've owned it since the breakout in early June, which is right here in this area. So the reason I like it is again, if we look at some of the things that we've learned today, we've talked about is, it's the market, while it was getting beat up here between September and December, the market went down 20%. Look at this thing. I mean, it didn't go down at all. And in fact, it went up. Second of all, we talked about RSI. We talked about momentum and that we want it trading above 30. So in the range of 30 to 100. Look at this. Not only has it been trading and spending many trips above 70, which is very positive and bullish, but the other thing is it really hasn't spent almost any time at all below 40, let alone 30. So I would say this is a stereotypical example of a very good high momentum stock and a positive trend. And just like surfing on a surfboard, as the trend is your friend. And if you catch a good wave, you ride that wave until it ends. So I really think that this stock looks really good right now anyway. Obviously that could change. Anything can change in a day, let alone a week or a month. So, but I just thought I'd share that. I thought it'd be fun to kind of illustrate some of the same lessons that I was talking about earlier in this video, not to mention previous videos we've done. All right. Well, that all said, thank you so much for watching and taking the time to listen. Feel free to share this video with friends. If you have any questions about the video itself, some of the concepts that we've covered, please let me know. If you have interest in a second opinion on your retirement plan, financial plan, estate plan, your investment management, it is free to go through our process. We require our clients go through a 3-appointment process to get a second opinion before we even think about investing a dime of your money. So if you have any interest in that, please reach out to us. You can either call us, you can email us at info@libertaswealth.com. Feel free to check us out online at libertaswealth.com. And we do have a firm minimum of $250,000. But with that all said, we also have a family discount. So we do not turn family members away of any kind, brothers, sisters, aunts, uncles, moms, dads, kids. So we do waive our minimum for family members, and we implement a family discount where we aggregate all the assets into one household. No one knows how much money the next has. So if you have an interest, please let us know. But again, even if you're not interested in a second opinion, you never have to be a client to ask a question. So here's all our contact information. And I do hope to hear from you at some point in the near future. But otherwise, hope you enjoy your summer, and we'll talk to you soon.